Effective contract administration will make your projects more profitable. There's no doubt about it. And that's why in this video, we're going to be covering everything you need to know about effective construction contract administration. We'll look at things like all the components of a construction contract, what specific clauses refer to, and then how to manage change and issues as they arise. This is part 2 of a 3-part series of videos we're doing on effective construction contract administration. In part 1, if you haven't seen it yet, you can click on the link in the description and it'll take you there. And it basically covers off the fundamentals of what a contract is. In this section, part 2, we're going to be looking much more at the details and specifics of what construction contracts contain and how to manage them effectively. So what is construction contract administration? Well, contract administration is the process that starts after the contract's been formed. So the principal and the contractor have signed a contract that states what the contractor is responsible for doing, building a road that's X kilometers long, that's this wide, within a 2-year time frame, and the principal's agreed to pay them $20 million for it, as an example. Then construction contract administration is basically the tools and processes each party should follow to maximize the chances of project success. So the contractor wants to get paid as much as possible and do the least amount of work. The principal wants to make sure they get the best finished product possible. And contract administration, we can break down into 2 separate sets of processes. We've got our business as usual, our routine, ongoing, repetitive tasks, and then we've also got change and issue management. So this is when things come up that weren't foreseen when the project was scoped out. So this is where we talk about things like variations, extension of times claims, these sorts of issues. The absolute first step of contract administration, as you could guess, is to understand the contract. Now, if you've seen the first video, I was talking about the contract like the rules of a game. So the contracts specify what each party is responsible for, what their obligations are, and how they're meant to manage the project. So the first step is to understand the rules of the game you're playing. What are we responsible for? What are we entitled to? And what rules do we need to follow? Obviously, if you were involved in the contract formation process, it's way easier to understand what was agreed to. But if you find yourself coming onto a project after the initiation, then the first step, you just need to understand what's in the contract. So construction contracts all follow the same general structure. There's the general conditions, so this is the outline of all the main clauses. There's the specific conditions, so if in the general conditions, they refer to liquidated damages if you don't meet practical completion. The specific conditions is where they define exactly what this liquidated damage amount is. $1,000 a day, $2,000 a day, something like that. Then, importantly, there's the supporting documentation. So these are all the attachments, things like the scope of works, the technical specifications, the design drawings, that really define the project scope. On construction contracts, the supporting documentation is often one of the most important parts of the agreement because the specifics of what we're doing is always unique and different. I don't know about you, but I find it really challenging to just read a document without some sort of task associated with it. Like I can't just look at a 70-page contract and flick through the pages and take in meaningful information. That's why I think the best thing to do when you're first reviewing a contract is to prepare something that's called a rights and obligations summary. Now, a rights and obligations summary at its basics is we're taking a 70, 80, 100-page contract and we're turning it into 2 or 3 pages that summarizes the key clauses, summarizes the key bits of information we're looking at. So it's basically just a simplified base summary of the contract that you can quickly look at and refer to during project deliveries. So it should be prepared in plain English, so you should take away all the legal jargon and just make it as simple as possible. And it should contain all the essential information for day-to-day project management. Things like time bars, things like the dates for payment claims, things like how often you have to submit the updated construction program. All that stuff should be in the rights and obligations summary. It's like a cheat sheet for the contract, and it should be prepared by the contract manager or the project manager. Contracts and all their supporting documentations on construction projects are ginormous. I've just been looking at one that had 1,000 separate attachments for a project. And construction contracts all sort of have the same structure. So there's our general conditions, which is basically like the outline of the rules. It contains all the important clauses. There's the specific conditions, which provide further relevant project-specific information. So the example I gave before was the general conditions will say that if the contractor doesn't finish the work on time, they pay liquidated damages. The specific conditions will define what the liquidated damages amount is. And then there's also supporting documentation. So there's attachments to the contract which define it in more detail. As you can imagine, if you're a contractor building a bridge, these supporting documentations will be things like the design drawings, quality specifications, the scope of works, the environmental management plan, all the documentations that define the deliverables and then how the deliverables have to be achieved. So anything that impacts the methodology as well. These documents all need to be either referenced in the R&O or if they're important, you could either be included in the rights and obligations summary. And basically, when we're reviewing the contract, when we're preparing the rights and obligations summary, we really want to be mindful to capture anything specific to the project. So we don't want to capture generic information. Like I wouldn't include a definition of liquidated damages in a rights and obligations summary because everyone knows what that means. But you'd include the liquidated damages amount. And the other important thing to note is during the contract formation process, there'll be a lot of negotiation, there'll be a lot of meetings, there'll be a lot of emails back and forth. But basically, if the documents don't find their way into the contract, aren't documented in the contract, they aren't really relevant. So it's really important that anything you agree to in the contract formation process finds its way into the contract, either as a specific clause or as an attachment. Just quickly about me, my name's Tim. I run a website called Construct IQ where we've got a ton of free training on construction project management. We've helped over 20,000 students, with 94% of students saying we've helped them master these fundamental concepts. So if you click on the link in the description, there's a free course on construction contract administration, and you'll also be allowed to download this set of slides. With all these different forms of attachments to construction contracts, what do you do if there's an error or there's a discrepancy in the documents that you've been provided? Well, first thing you have to do is to notify the other party. And when that happens, the principal is going to nominate the correct interpretation if there isn't already an interpretation of documents clause in the contract. So some construction contracts will have a specific clause which has an order of precedence, which determines in what order you're meant to interpret the document. So for example, the scope of work says one thing and the design drawings say another. The scope of works is higher in that order of precedence, then the scope of works will contain the correct bit of information. But if there isn't an order of precedence clause, then it'll be up to the principal to determine the correct interpretation. And if there's an impact on the cost or schedule, the contractor is going to be justified in claiming additional money or time. And if there's not, well, there's no impact. As an example, for an earthwork subcontract, say there was a discrepancies between the bill of quantities and the design drawings. Would this be a variation? Well, the first thing you've got to check is the order of precedence clause in the contract. If the bill of quantities has a higher order of precedence than the design drawings, then there wouldn't be a variation if the pricing was based on the bill of quantities. However, if the design drawings had a higher order of interpretation, but the pricing was based on the bill of quantities, then there would potentially be a variation. And this same logic can be applied to conflicting performance requirements like quality specifications, or if there was conflicting scheduling requirements. When you're managing a construction contract, it's essential to use proper communication channels. So what I mean by this is that the communications you're using should be in line with the contract. So if you actually look at construction contracts, usually there's going to be a clause that determines how you're meant to communicate claims. It'll say, for instance, they have to be in writing, they have to be in English, or they have to be in specific language. And I mean, that's all probably going to be basic common knowledge depending on where you're working. However, the important thing you have to pay attention to are time bars, so the timing of communication. So most construction contracts have in them specific clauses about time frames. You have to make the other party aware of certain things. So these are referred to as time bars. So for example, if you're a contractor and you become aware of a variation, you might have a set time from which you become aware of the variation that you have to notify the principal. And if you don't make them aware during this time period, you could potentially lose entitlement to the variation. So you have to particularly pay attention to the timing of when you have to communicate things. I'm going to start talking about contract administration in the framework of delivering the project as planned. So this means both parties are carrying out their rights and obligations within the circumstances which we envision the project playing out. So we'll call this business as usual contract management. And I'll just quickly go through the responsibilities of each of these parties, the principal and the contractor. So the principal has to maintain insurances and security, has to provide facilities and access to the site, has to review the construction program that the contractor prepares, has to review and approve any payment claims. So there'll be interim payments throughout the completion of the works. The principal has to review and approve these. There'll be a requirement to review and approve quality documentation. So as the contractor completes the works, there'll be certain points of time at which the principal has to inspect the work, review documentation, test reports, these sorts of things. So they'll have to review these. And they'll also do some sort of auditing of the inspection and testing process, basically to make sure what the contractor is building, they're happy with. On the other hand, the contractor is going to have to maintain their insurances and security. They're going to have to complete the contract works as defined by the contract documents. And basically that means if they're being paid to build a bridge, they have to build the bridge. That's pretty basic. They'll have to maintain a construction program. So they'll have to develop and maintain a schedule that shows when they're planning on finishing and basically prove to the principal that they're properly managing the project. They'll prepare and submit payment claims. So as they complete the work, they'll make interim payment claims. And they'll also have to maintain a quality assurance system. So they'll have to do some sort of inspection and testing to basically prove that what they're building complies with the specifications. And obviously this is a super simple overview of what's involved in managing a project, but from a commercial point of view, it covers all of the key points. So in that big bucket of administrating a contract is the contractor's principal responsibility, which is delivering the project scope. What that basically means is building what they said they were going to build, completing the contract scope. And it's basically, in commercial terms, it's providing the goods and services as defined by the contract documents in exchange for the agreed payment. So providing the goods and services as defined by the contract documents. So that's a key point, how it's defined in the contract documents. And that's why understanding the documents attached to the contract and what they're technically defining you to build. Because remember, we're talking a lot about contracts in commercial terms, but fundamentally, these are engineering projects. It's about delivering a technical requirement. Building a bridge, there'll be a concrete specification, there'll be a reinforcement specification. So even though these are all technical documents, they have relevance in terms of the contract. And summarily, we can refer to these documents as the scope of works. That's how I like to think of them. They all form part of the scope of works. And the scope of works we can define as the principal's description of the work to be completed under the contract. It's going to consist of design drawings, specifications, schedules, project management plans, and these sorts of things. And I'm also going to put a link in the description to an example scope of work. So if you'd like to have a look at it, and you can see further what I'm talking about. The scope of works defines the exact responsibilities for the principal and the contractor. So what's the principal responsible for? So what access is the principal going to provide? And then what is the contractor responsible for? So what specifically is the contractor going to be doing? And there's the reason, in my experience, there are so many commercial disputes on construction projects isn't the clauses in the contracts, it's the differing content in the scope of work. So you can imagine you're building a train station and you need a contractor to complete the electrical works. Then you're going to need electrical drawings, different specifications, provide them a schedule of when they're going to get access to different parts of the scope. And if you think about the magnitude of everything you're going to have to define that they're responsible for, to me, that is where the gray area exists in construction contracts. And that's where you run into differing interpretations and specifications. And basically, that's where all the confusion exists. So if you can think about all the decisions you'd have to make about an electrical package on a train station, who's doing the trenching, who's doing the underground services, where are the connection points for the existing infrastructure? Are we upgrading a new point of supply? Does someone have to pay a utility fee? Who's paying that utility fee? Who's doing the design for the utility connection works? There's just all these elements of the scope of works that when you're preparing a scope of works, you're going to have to define very, very clearly. So basically, people know exactly what they're doing. It's crystal clear in the contract documentation. Then you can refer back to this later when you're managing the project. The next critical element in the construction contract is time. So if we think of scope of works as the physical deliverables, time in contracts answers the when. When are these deliverables required? And time is ultimately a critical issue because time equals money. So if you think about the way we incur costs on a project. So you have management staff, you're renting office facilities, you're paying for a security guard at night, you're paying for temporary fencing. There's all these ongoing costs to a project. So looking specifically from the perspective of a contractor, the longer a project takes to build, the more it's going to cost. So if a project takes a day longer, if all these security guards, project managers, salaries, these ongoing recurring costs, they might be $100,000 a day. They might be $1 million a day. So every day the project takes longer to finish, we're going to keep accruing these costs. From the principal's perspective, time is such a critical issue because they're basically building something to generate revenue. So if you imagine a property developer who's building an apartment block, they want to build the apartment block and sell them and generate cash for them, or they want to rent them out and generate rental income. So the longer the project takes to finish, the more they're delayed at generating revenue from the asset. So that's why how quickly you can build something and the time frame people commit to is always a critical issue. So time is defined in construction contracts pretty clearly. And typically the contractor will be responsible for delivering their package of works within a certain fixed period of time. Now I'm just going to go through some of these key terms you'd see in a construction contract relating to time. So the first one we're going to have is contract award. What date is the contract awarded? When does the work under the contract start? And that's also important to understand the possession of site date. So that's when the contractor is handed over the site by the principal and can physically start works on site. So usually in a contract, you'll have a contract award date where the contractor starts mobilizing their project team, starts writing their project management scopes, starts preparing their design, procurement, these sorts of things. And then there'll typically be a physical site access date. So both of these will be key milestones in the contract. And then you'll have a practical completion date. So there'll be a date you're meant to finish the project work, which is referred to as a practical completion date. A lot of projects are broken up into stages. So there might be a stage for building, say if you're working on an apartment building, there might be a stage for physically finishing the apartments, and then there might be a second stage for finishing all defects. Or if you're working on a solar farm, there might be a stage that you've physically assembled the trackers and the panels, and then a stage that you've finished the commissioning. So the construction contract might have lots of different points in time in it. It might say you have to finish the construction works by this date, and then you need to be exporting power at a date that's 3 months after that. So these dates in the contract are referred to as separable portions. When there's a change to the contract conditions driven by the principal, so for example, you work on an apartment building and the client comes to you and say, we want to add in another elevator, and you're in the design phase and you're saying, and as the contractor, you say, we're happy to do that. It's going to cost an extra $5 million to install the elevator, but it's going to delay our design and construction works by an additional 3 months because we've got to order the additional elevator. We've got to integrate it into our design. We've got to update our ordered drawings. It's going to push back when the drawings are ready to begin construction, and it's going to extend our program by 3 months. That's referred to as an extension of time claim. And what happens when you have an extension of time claim is it changes the practical completion date in the contract. So if you're meant to finish in July, you get a 3-month extension of time claim. You'll now be finishing the project work in October. When the project finishes is when the defects liability period starts. So that's another time in another date that's specified in the contract, the practical completion date. So the actual practical completion date, when you physically finish the work, is when the defects liability period starts. So that's when construction's complete and the contractor is responsible to come back to the site and rectify any defects. The contract will also specify a duration for liquidated damages. So it might be a 12-month defects liability period or it might be a 24-month defect liability period. So that duration is also specified in the contract. And what happens if the contractor is late in meeting their practical completion date? So they say the contract says they're meant to finish on the 1st of July and they finish on the 1st of August. Well, contracts also specify a delay penalty. So this is referred to as a liquidated damages rate. It might be $1,000 a day, $2,000 a day, depends on the size of the project. And that's a daily penalty that you get charged every single day if you're late in completing the project. So if you're delayed in finishing by 30 days, delayed in reaching practical completion by 30 days, your liquidated damages rate is $1,000 a day. You'll get charged $30,000. In addition to having these set points in time where the contractor is required to meet deliverables, the contractor is almost always required to maintain a construction program. So a construction program is a list of all the activities in the project, the duration of these activities, and the sequence they have to be completed. And so think of a Gantt chart. Think of something like Microsoft Project. I'm sure everyone's familiar with what a schedule is. And so what? The responsibility of the contractor to maintain a program. So typically in the contract, it will be specified that every 2 weeks, the contractor is required to issue an updated construction program to the principal. So they're required to maintain this program, update when activities actually start, when they finish, and so on and so forth. And then they'll be required to regularly submit this and to basically keep the principal informed of what's happened on site. And so some of the key terms you'll see relating to a construction program are the activities, so the tasks required to complete the project, the sequence they have to be completed in, any critical milestones, the critical path. So the critical path is a term you hear a lot in the project management space, and a lot of people use it incorrectly. The critical path is the series of activities that, if delayed, delay project completion. So these are the activities that, if they get delayed, will affect the practical completion date. And so these activities have no float. So float is how much you can delay an activity before it surfaces on the critical path. Then there's also the term a net versus a wet schedule. So a net schedule is your actual estimated durations. A wet schedule has contingency built in it. So if the contractor's holding 10 days of contingency, the wet schedule will show the original schedule with this 10-day buffer. There's also an as-planned versus an as-built schedule. So an as-planned schedule is a forward-looking schedule where we're predicting what will happen in the future. And an as-built schedule is where we've updated it with our actual completion dates. And the final concept in a schedule is substantial versus full completion. So substantial completion is where we physically finish the construction works, and full completion is where we've finished every defects, closed everything off, and can apply for practical completion. On the screen, I've just got a really basic example construction program. So it shows a sequence of activities, each of these activities with different durations and start dates. So we've got mobilizing to site, establishing temporary laydowns and site sheds, clearing and grubbing, earthworks, drainage, car park lighting, asphalting and curving. So it's the program for the construction of a new car park. And you can just see it shows all the different activities, when they start, when they're planned to finish. And you can also see the overall duration of the project. The next key concept of construction contracts, and always a contentious one, is payment. So why is payment important? Because basically, payment is the primary obligation of the principal, and the contractor at the end of the day is there to get paid for the work they're doing. So payment always becomes an issue because there's issues with valuing how much work's being complete and also the timing of payment. So both of those are important issues to be aware of in construction contracts. And payment is also used as a way of motivating the contractor to do things. So if, for example, if the principal thinks there are defects in the work, they might hold back payment from the contractor for that portion of the works because they don't value it as being fully complete. And they also use it as a form of security. So if you think about security, I'll talk about in a second, but security is basically a bond the principal has over the contractor where they can use it as motivation for them to do work. So the reason you have security is, say there's a big dispute between the principal and the contractor might decide to walk off site and leave the principal with an absolute mess, and they have to bring another contractor in. For that purpose, construction contracts mandate holding security so that the principal can actually cash in a bank guarantee or hold retention money and recover some of the costs from disruption caused by the contract. So withholding payment or unpaid bills act as a form of security. So that's why, and it'll make a bit more sense when I talk about security. And ultimately, payment always becomes an issue because cash is king on construction projects. And so when you're looking at a construction contracts, the key things you want to be aware of are the payment mechanism. So whether it's a lump sum contract, a schedule of rates contract, or a cost reimbursable contract, the payment claim process. So what's the specific claims and, what's the specific process around how and when you make claims during the works, and also the pricing schedule. So how the payment schedule is broken down. So these are key things that contract will explain. The first thing we need to understand are the different payment mechanisms used in construction contracts. So the most common one that you're used to seeing are fixed lump sum contracts. So this is when the principal goes to the contractor, we want a fixed quote to deliver this defined package of work. So fixed cost contracts are used when the scope is clearly known upfront and lump sum pricing can be requested. And then any changes to the scope during delivery are constituted as variations. The next common form you have is where you use a schedule of rates contract. So a schedule of rates contract's used when you know the activities, but you don't know the quantum of work. So say, for example, we need to dig a trench. We know the trench will be between 1 kilometer to 2 kilometers, but we're not exactly sure what. So we want a unit rate per meter for a contractor to come and do trenching, and we're going to pay them based on the actual lineal meters of trenching they do, rather than a lump sum because we don't know the quantity. A cost reimbursable contract is when the scope's unclear, we're unclear of what's actually required to be done, and we don't want to deal with any variations during delivery, so we're just going to pay the contractor the actual cost of doing the work. So cost reimbursable contracts are used when you have messy, complicated projects and it's hard to clearly define the project scope or develop a clear-cut schedule. And the final form you've got are target cost contracts. So these are relationship-based contracts. They come in lots of different forms, but the general idea behind them is the client and the contractor work together. They develop a target cost, and then if the contractor exceeds this target cost, they share the pain. So they share the pain of going over budget, but then if the contractor comes under budget, then they share the gains from it. So that's a target cost contract, which you see in more bespoke situations. Let's do a brief exercise looking at two different situations and try to think which type of contract would best suit each situation. So the first example, imagine we're building a new warehouse. We've got an issue for construction drawing set. We know exactly what we want a contractor to do, and the scope is crystal clear. Well, in that situation, we'd go as the principal, would make most sense for us to choose a lump sum fixed fee contract because we can clearly define the scope up front. We're unlikely to come across any major variations, and we can get the best pricing from the market, and there's the least the risk on us. On the alternative, what about an earthworks subcontract where we know that we want someone to do clearing and grubbing and bulk earthworks, but because maybe we don't have good geotechnical data, we actually don't know the quantum of material we want them to move. So we know the individual activities, but we don't know the quantum of work. Well, in that case, a schedule of rates contract would be best suited to our project. Once we understand the payment mechanism used in the contract, the next thing we need to look into are the payment specifics. So we've got payment terms. So this is where the amount of time from when we submit an invoice to when cash ends up in our bank account. So payment terms might be something like 30 days from end of month. So once we submit an invoice, at the end of that month plus 30 days is when we get money. So contractors are particularly super focused on payment terms because if you think about it, they're paying their labor, their materials, everything weekly or quite regularly. And so if they get really extended payment terms, they might be out on a big contract, hundreds of thousands of dollars cash negative. So that's why payment terms are also important. Security is also really important. So when you have retention, so whether a percentage of each payment claim is held as retention or whether you upfront provide bank guarantees, there'll be specific terms about payment for offsite goods. So for example, if you've got a big material supply scope as part of your contract and you order all these materials that you need for the works, but then you can't install them for another 3 months, contract will usually specify as the contractor you're entitled to claim for materials off-site. There'll be timings for the payment claim process. There'll be a date when claims have to be submitted. There'll be a time frame for which the principal has to respond. So if you make a payment claim, principal usually have to respond between 5 to 10 days. And because payment is such an important issue in construction contracts, and it's specifically used by contractors or principals to motivate the other party, that to prevent bullying and unfair actions by different parties, there's a lot of laws around payment in construction contracts. So there's legally mandated requirements on payment terms or how quickly you're meant to respond to payment claims, because these cash flow issues cause such massive issues for construction contracts that you can even have profitable projects where companies go broke because of the payment terms, even though they're actually making money on the contract. So you always want to make sure you understand the payment terms in the contract. So how does the payment claim process work on a construction contract? Well, it starts with, firstly, payment claims aren't just made once off during a project. You don't finish the entire project scope and then you get paid for it at the end. They happen at interim points throughout the contract. So the first stage of the payment claim process is the contractor will submit a claim to the principal. So they'll say, if we're doing trenching, we've done 50 meters of trenching. Our contract was to do 200 meters, so we're claiming 25% of our contract value. So they make a claim to the principal. The principal then assesses this claim. So they have a fixed time frame, something like 10 days usually, where they need to respond to the payment claim. So they'll look at this and they'll ask, well, the contractors submitted a claim for 50 meters of trenching. Have they actually done 50 meters of trenching? Have they done it correctly? Have they submitted all their QA documentation? Are they correctly claiming the milestone in the contract, or is the contract value broken up? Are they meant to submit as-built drawings? All these sorts of things they'll look at, and then basically they'll respond to the contractor's payment claim and say, well, you're claiming 25% of your contract value. We really think it's 20% because you haven't submitted any QA documentation. The contract and the principal then negotiate the specific amount being claimed. They'll show supporting documentation and evidence. Then through this negotiation period, once it's complete, they agree on an invoice amount. Principal issues a payment certificate. The contractor invoices against this payment certificate, and then the amount of money, whatever the value of the payment certificate, the cash will go into the contractor's bank account on the date based on the payment term. So if it's 30 days from end of month, if the contractor submits their invoice on the 25th of July, they get paid 30 days at end of month. So from the end of that month plus 30 days, they'll then get paid on the 1st of September. So you can see there's quite an extended period of time from when you submit a claim to when you actually get money in your bank account. And that's why the payment claim process always becomes an issue on construction projects. Very related to payment claims, and always an issue on construction projects as well, is quality and defects. So what is quality? Quality is pretty much the process we go through to verify and validate that what we've built matches the drawings and specifications. So that's quality management, and construction contracts always define quality and defects specifically because they always become an issue. So the quality requirements in the contract will basically define the standards of workmanship that have to be met. And these are defined by the scope of work. So the design drawings, the performance specifications, and these sorts of things. But then also importantly, there always becomes this element of subjective interpretation. So there always becomes some element of individual interpretation to this. Quality assurance is then the system the contractor uses for documenting compliance. So if you think about the design drawings specify that we need to build a concrete foundation that has to use 32 MPa concrete. The concrete specification says that we have to do concrete testing. The contractor then takes this information and puts it into their quality assurance system. They'll use inspection and testing and check sheets, and then it's their responsibility to prove to the principal that they built that concrete foundation in accordance with the design and specifications. If there's any failure to meet these requirements, it becomes a defect. So a defect is basically a failure to achieve the quality requirements, and the contractor is responsible for fixing any defects. So if they pour the concrete foundation and it starts to crack, they're responsible for fixing that cracking. The defects liability period is the period of time after which the project reaches practical completion. So when the project finishes, when the contractor is responsible for coming back and fixing defects, and the principal holds security. So it's an important point to note that even at the expiration of the defects liability period, the contractor is still responsible for fixing defects, or can become very hard to prove they're actually construction defects. But at the end of the defects liability period is when the principal gives back this contractor's security. So they don't actually hold any more security over the contractor. So when we talk about quality, the cost and responsibility of maintaining a quality assurance system is the responsibility of the contractor. Almost all construction contracts will have clauses in there about quality assurance, and it's the responsibility of the contractor to maintain a quality assurance system. So they need to maintain some sort of system that proves that they're building the project in accordance with the design documentation and the specifications. The principal can do testing. So it's the right of the principal to be able to come and inspect and check the works. And typically how it works in construction contracts is the principal can do additional testing. However, they have to bear the cost of it. unless the principal can prove that they've uncovered defective work. In that situation, typically the principal can actually backcharge the contractor the costs of the additional testing. When the principal becomes aware of a defect in the construction works, they'll send the contractor a direction to remedy. So, typically, unless it's a serious defect and there's some level of dispute around it, it wouldn't get to the point where you're sending commercial letters. But if it does, the way the contracts play out is the principal will send the contractor a letter. They'll say, we've identified this defect. We believe it's a defect under this quality requirement and you've failed to meet it. You then have to go rectify it and then the contract will nominate a set period of time within which they have to go and rectify the defect. So it might be something like 10 days, but ultimately it depends a little bit on the specific nature of the defect and whether that's a reasonable time frame. And then what happens is, after this time period expires, the principal can then actually engage another contractor to come back and remedy these defects and recover the costs from the security they hold over the contract. This is true up until the expiration of the defects liability period. So as I said about on the last slide, the defects liability period is the period after practical completion when the principal holds security over the contractor. So up until the end of the defects liability period, the principal is holding security. If the contractor is refusing to come back to site to rectify defects, they can actually take money out of the security. They can cash bank guarantees or take money from the retention pool they're holding and then pay another contractor to come back and rectify the defects. And then, as I was saying before, theoretically, at the expiration of the defects liability period, under a warranty, a contractor is typically still responsible. The big difference is it'll be harder to prove after the more time goes by because the assets started to being used. So practically, it's hard to prove that it's a construction defect, but then also the principal won't be holding security over the contractor. I should have put this security slide earlier because I've already spoken about it so much, but security is principal can also provide security, so I should clarify that. But security is a sum of money to the other party that basically the party who's holding the security can cash or use if the other party fails to perform their duty. So typically the principal will hold a pool of security if the contractor is failing to do things like come back to site and rectify a defect, or they say this contractor goes bankrupt and doesn't finish the job. The principal is holding security over the contractor. So they can then cash these bank guarantees and basically pay other contractors to come back and finish the work. So there's a couple of different types of security. There's retention, which is where there'll be a percentage reduction from each payment claim. So maybe it's like a 5% retention on a contract. You can have a bank guarantee. So a bank guarantee is basically a piece of paper given by the bank that the contractor pays for from the bank and then gives it to the principal. And at any point in time, if the principal holds this piece of paper, they can go to the bank and cash it and get the value of that sum of money. The last form of security, which isn't a traditional form of security, but acts the exact same way, and I spoke about this during the payment section, is that the value of the work the contractor's completed, but they haven't been paid for yet. So if the contractor's done $1 million of work this month, they've put in a payment claim, it's been approved, but they're not going to get paid for another month after that because of the 30-day payment terms of the contract, that additional money acts as a form of security because theoretically the principal is still holding some value of money over the contractor. They haven't paid them yet for work they've already done. Insurances in construction contracts act effectively the same way as insurance on your car or insurance on your house. So insurance provides a guarantee of compensation for a specified loss. So if you've got insurance on your car, somebody breaks into your car and your car insurance covers theft and burglary, then you'll be able to get the money back from the insurance company that it costs to repair your car. So people take out insurances for two reasons. They take out them for risk management for the specific project, but then there's also legal requirements to hold certain insurances to protect the principal, the contractor, and also employees and members of the public. So construction contracts mandate that contractors hold certain insurances. So we're talking things like public liability insurance, workers' compensation insurance, professional indemnity insurance, and then depending on the project specifics, it might be things like motor vehicle insurance or marine transit insurance. Okay, so that took us to the end of our business as usual contract management. We just went through all the routine elements of a construction contract and that people do day in and day out. So they deliver the project scope, they take out insurances, they hold security, they maintain a construction program. Those are all the routine contract administration tasks, making payment claims, approving payment claims. And these tasks really all revolve around things going as planned. But as we know, we work on projects, we work in uncertain environments. What happens when things change? So that's when we move from our business as usual contract administration into our change and issue management. This is how we manage the contract when circumstances change. So circumstances might change because of poor performance by one or both parties. The contractor might be disorganized, not coordinating things properly, not checking their work, having a lot of defects. Or the principal might have issues. The principal might be delayed in giving site access to the contractor, or for some reason they might be refusing to pay them. In these situations, either party is able to make claims and the contract is also able to be varied. So when the situations change with the contractor, they'll be able to make claims for time. So they'll be able to make acceleration claims, delay claims, disruption claims, and they'll also be able to vary the contract sum. So increase or decrease the value of the contract sum. Then when each party start to have issues, they could go into default. And then if there's disagreements between the party, they could evolve into a dispute. And contracts specify how you're meant to deal with claims of variations, how you're meant to deal with default, and how you're meant to dispute. So contracts map out a way forward for how we deal with project management when the situations and circumstances change. The first type of change I want to talk about are variations. And we all know this classic picture of the boat which says contract scope on the little boat and then change orders on the big boat. And it's clearly a joke about a contractor who's only been able to afford a tiny boat with a contract sum, and then from all the variations they've paid for this massive yacht. And that's in a way the game of from a contractor's perspective, that is the game of contract administration. They tend to quote jobs low and then they make all their money for variations during construction. So variations and managing them properly, whether you're a principal, whether you're a contractor, is a game you have to understand how to play. It's incredibly important. And variations will happen on projects. Why? Because projects are complicated. Things never plan out exactly how we think they're going to. So change will happen and we can't perfectly plan for everything. There'll be mistakes and omissions in the drawings, and unknown and unknowable circumstances will arise. So construction contracts have provisions to facilitate change, the ways to manage variations, and variations significantly impact the project outcome. So they'll impact the budget and they'll impact schedule. A variation is an agreed change to the contract by both parties after formations. The origin of a variation is always going to be a change to the contract condition. So if what the contractor quoted to do the job on, the documentation, the scope of works, the drawings, the schedule, all these things, that's different to what is happening now, then there'll be grounds for a variation. Can be an addition or a reduction in scope, a slower or faster completion, or a change in the quality standards. And the output's going to be changed contract conditions. So a change to the project completion dates and a change to the contract lump sum. There's two main categories of variations. So there's proposed variation. So this is where the principal requests the contractor to change the scope before the work's complete. So the example I used before of if you're working on a building and the principal wants an additional lift shaft, or the principal wants the contractor to install an additional air conditioning unit. It's clearly a variation. It's an additional requirement that wasn't there when the contract was formed. Everyone agrees it's a variation. Second type of variation are variations claimed. So this is where the contractor claims to the principal that there's been a change of scope. Maybe the contractor's been delayed in giving access to site and they want to claim additional time and money. The contractor is not given full access to site for whatever reasons, the situations are different, or if, for example, there was a mistake in the design drawings and the contractors had to do additional rework. So these are situations where the principal isn't coming to the contractor to say, hey, we've changed the contracted conditions, please can you send us a quote to do this? It's where something's happened, the circumstances have changed, and the contractor's saying, hey, wait a second, I'm entitled to additional money for this. So the result of variations will be time, so adjustments to the date for practical completion. So this might be for the entire project scope, or it might be for specific separable portions. There'll be financial impact, so there'll be an adjustment to the contract sum. And that's why when we talked about the different payment mechanisms before, on a project where the scope is unclear, it might be best to choose a cost plus contract because then you won't have to deal with all these variations. Variations can also result in changes to the scope. So they might agree that they're going to install an additional air conditioning unit, and now this new set of drawings is the basis for the design. There might be change to performance standards. There might be changes to the risks each party is responsible for, or there might just be changes to specific terms and conditions in the contract. So that could be a form of variation as well. So now I'll go through the process of a proposed variation and then the process of a variation claim. So a proposed variation starts with the principal proposes additional scope before the date of practical completion of the contract. The contractor will then advise whether this change is actually feasible. So sometimes if you say to a contractor, can you do this? They might actually say, no, it's not practical now. But if it is, they'll advise the impact of the cost and the schedule. They'll then send this to the principal. So they're responding to the proposal for the principal. The principal is going to assess this, negotiate it, and review it. They might think the contractor is drastically overpricing them to do this additional work. And everyone's very aware of variations during construction because people know that's how contractors make all their money. They tender the core scope at a low price. And then because variations aren't charged competitively, they're not priced competitively because a principal can't really go out to 3 contractors midway through a project and ask them to do this tiny bit of additional work. So they're not really priced competitively. So contractors tend to put more profit margin on them. So principals will generally review them in a lot more detail and ask way more questions. They'll negotiate this price, and then the principal's got to decide whether they want to proceed or not with this variation. If they'll approve it, there'll be a change to the contract sum and the practical completion date, and there'll also be a change to the requirements that the contractor is required to deliver on. I think that's an important point to note as well. So like, if someone quotes to do a variation, it agrees, it gets formed part of the contract, then that is the cost they have to deliver the work for. So it's the same as it's just an adjustment to the lump sum. They can't go back halfway through doing the variation and then say, oh, we actually underquoted the work to do this additional variation. We didn't factor in the delay to the schedule and we're not covering our indirect costs. In practice, they can't do that because they've quoted to do this additional work. So that's why as contractors, you should really be aware of capturing all the additional changes from a variation. So you're not losing money on a variation. And then if, on the other hand, if the principal decides it's too expensive to proceed with the change, then they'll just reject the variation and not proceed with it. On the other hand, a variation claimed follows a different process. So the key difference being the proposed variation started with the principal, the variation claimed starts with the contractor. So the contractor becomes aware of the grounds for a claim. The contractor will then submit a notice to the principal and details of the claim. The important thing here, and I mentioned this when I was talking about contract communication, is it has to be done within the time bar. So if you become aware of grounds for variation, as a contractor, there's a fixed period of time in which you have to notify the principal of this. Even if you're not quoting it, even if you're not submitting a price or a schedule impact, you just have to let them know we have become aware of this variation. So that's why it's really important to understand when you're looking at the communication part of the contract that you understand your time bars. And the reason this is in the contract, so you couldn't say there was an issue that came up in the design phase and then a year later the contract is actually turning around and saying, oh no, that change caused us all these other issues. You can't do that. As soon as you become aware of the grounds for variation, you have to notify the principal within a set period of time. So the contractor is then going to submit the notice of this claim and details of the claim, and it has to be submitted within the time bar. And then the claim is going to be assessed by the principal. They'll have to justify and understand who caused the delay. If the contractor was the cause of this issue or this claim, obviously there's no grounds for a claim, so a contractor can't delay themselves. If it's the fault of the principal or both of their faults, then it's grounds for a variation. The contractor's then got to justify what the change in the project completion dates are, so there'll be some analysis of the schedule. That's why it's important to have accurate construction schedules that really reflect how the work's being done. And then from the contractor's perspective, you also want to be able to justify where a variation allows you to claim additional time. So you really clearly want to understand your critical path, but that is more a topic getting into project scheduling. And then once they agree on the value and the change to the practical completion date, there's an adjustment to the contract or a variation to the contract. Any variation that impacts time will classify as a time-based claim. So because the risk of completion by a certain date with heavy financial penalties applied to it, the contractor is always going to want to try to claim for additional time when the project duration's been adjusted. So there's a couple of different adjustments, I guess, you could have to the project schedule or variations to the project timeframe. So there's acceleration claims. So this is a form of proposed variation where the principal is asking the contractor to finish earlier. So the principal is requesting an earlier practical completion date, and the principal and contractor will agree on an earlier date to finish the contract, and it'll always come with additional money. There's a delay claim. So it's when the principal causes delay to a critical path activity, which allows for time and money. There's a disruption claim. So that's when the principal causes delay to a non-critical path activity. And because the critical path of the project hasn't been affected, the contractor is not entitled to claim for an extension of time. And then the final form, joint and neutral claims, which depends on the specifics of the contract, but it's where there's no fault by the contractor or joint fault, and typically you're only allowed to claim for time, not money, but that's not really a form of claim you see often in practice. So looking at an example construction project schedule, imagine the contractor needs an environmental approval for the construction of a car park from their client to start the clearing and grubbing. The client is delayed in giving them this environmental approval. You can clearly see from the schedule that delaying the clearing and grubbing is going to delay the project schedule. So it's not a disruption claim, it's quite clearly an extension of time claim. Every date the principal is late in giving the contractor this environmental approval to start the clearing and grubbing is going to delay the practical completion date. So the contractor would be justified in submitting an extension of time claim. So now we've discussed the different forms of time-based claims. There's a form of default, which is important to talk about here when we're talking about time in construction contracts, where the contractor is responsible, as we discussed before, in maintaining a construction program, but they're not meeting this construction program. So they keep submitting a schedule to the principal showing that they're going to have this many people on site, they're going to be getting the work done this fast. And if they're constantly slipping, this actually becomes a form of contractor default. So if you have a contractor working for you who keeps submitting schedules and you know they're not going to meet their practical completion date, typically in a construction contract, that actually constitutes a form of default. So as the principal, you'd be allowed to engage other contractors, take money out of their security to ensure they finish the work on time. So that's why the construction program is such a critical contract document. So now we've introduced the concept of default, I'll expand a little bit more on it. So what is default? So default is when one of the parties of the contract, either the principal or the contractor, does not uphold their side of the deal. So construction contracts have remedies for the wounded party. So wounded party is just a fancy way of saying the one who has been doing their part by the contract. And the remedy in the contract depends on the party at fault and the nature of the fault. So whether the principal or the contractor is at fault and exactly what they've done. So if they've just done something really, really minor, you can't go and cancel the contract. But if they've done something major, then there's grounds for canceling the contract. So that basically means the remedy in the contract for default is going to depend on the party at fault and the nature of the fault. And there's also a set of circumstances called frustration, which is different to default, but it's where at no fault of either party is the contract unable to be executed. So there's some other external situation that's come up and the contract, for whatever reason, can't be properly executed. So what are the forms of contractor caused default? So how can the contractor be in default for the contract? So they can be delayed in their progress. So as I was speaking about with the construction program, the contractor is constantly failing to meet the schedule they need to meet practical completion. That's a form of default. Having defective work and failing to rectify is a form of default, and failing to provide security, failing to provide insurances. The principal in those situations has the following remedies. They can take work off the contractor. So in the example of the contractor being delayed, they could engage additional contractors to come in and do portions of the work. They could terminate the contract and they could sue for damages. The principal can be in default for failing to provide access to site, failing to pay the contractor, and failing to provide securities and insurances. So there's less things the principal can do to be at default, and contractor in those situations has the right to suspend work, so stop working, to terminate the contract, and to sue for damages. When either party's in default, there's a simple process you have to follow. First is you have to send a notice to show cause. You have to send a notice or a letter saying where you think the other party's in breach of the contract, provide details and specifics. And you also have to set a time within which this cause has to be shown from. The other parties should respond with reasonable cause, so they should have some justification for acting the way they've done. And then remedies will need to be put in place if there's failure to show cause. So in that situation, the contractor failing to meet the construction program, the principal would send them a notice saying you failed to meet the construction program as required by clause 39.6, and you have 1 week to respond to this, showing what you've done, why you've done it, and what you're going to do about it in the future. If they fail to do this, the principal would be entitled to then engage another contractor to take a portion of their project scope and then take money from their security to offset this. With all these changing circumstances on projects, it's inevitable that there's going to be disputes. So disputes are basically when, for whatever reason, the principal and the contractor, they can't come to agreement on a certain point. Contracts also specify the different processes that we're meant to follow when a dispute arises. So disputes, by the time you get into the stage where you're in disputes, you're almost certainly going to be getting lawyers involved. So there's not much point going through this in too much detail, but the basic process, which a construction project will spell out, is that you have to send a notification or a commercial letter that the parties are in dispute. You're meant to have some sort of conferencing, and then there'll be a nominated dispute resolution process in the contract. There's several different dispute resolution processes that the contract could have. You could have litigation where the parties go to court. So litigation doesn't require consent from both of the parties, but you need to involve lawyers. You've got to pay court fees, so it's expensive and time consuming. You can have commercial arbitration, which is cheaper and shorter, but requires both the consent of both parties. And it can basically end up being long and complicated, or you could have expert determination, where the simple and the fastest, where both parties agree to appoint an unbiased expert who's going to listen to the facts like a judge or something and make a decision. But again, you need both parties to consent to it. I hope you really enjoyed that summary and it gave you a good foundational understanding of the two core elements of administrating a construction contract. So we spoke about business as usual, things like payment claims, security, insurances, these sorts of things. And then we spoke about variations and changes. So what happens when circumstances change from what we expected. There's going to be a part 3 to this series of lectures where we're going to be talking about some tools and recommendations for effective contract administration. But remember, in the link to the description of this video, I'm going to put a link to our website where we've got full 3-hour course on construction contract administration with downloadable slides, quizzes, and practice activities so you can really master these skills. So thank you very much for watching, and I hope you enjoyed.